Good day, grade 12 learners. Welcome to today's accounting lesson. My name is Paddington Zinzombe. This lesson is brought to you by the Gauteng Department of Education in collaboration with the Sci-Bono Discovery Center. And this broadcast is being brought to you by Pakama Research and Development. Today's lesson is on financial indicators. Financial indicators. Now, financial indicators are those that we are going to use in order to interpret financial information at our disposal so that our stakeholders can be in a position to understand it better. Now, today's lesson objectives are as follows. We are just going to have to look into the classes in which financial indicators are put into. In fact, we are going to look into the classification of financial indicators as the first thing. The second thing that we are going to do is to look into how do we go about calculating financial indicators. Unfortunately, we are not going to go through all of them at once because of time, but we are going to indicate to you how best you can be in a position to deal with situations in which you are requested to calculate financial indicators. And then lastly, we are going to look into how do you analyze and interpret financial indicators. Because if you are given a certain class of financial indicators, they are supposed to be in a position to communicate a specific message. So can you be in a position to make sure that you can communicate given the financial indicators? So to start with, we are going to look into these financial indicators class by class, starting with our our profitability ratios, our profitability indicators. Now, if you check on the slide that I've given you just now, we are given about 5 indicators which are the indicators that indicates profitability. And if you can check here, it is measuring around sales, cost of sales, gross profit, operating expenses, and our net profit. And please take note, you are given a formula for every indicator. Let's just look into the first one. For example, gross profit on sales. Now, what is the formula for that? It's gross profit divided by sales. And then we multiply by 100 because every time the answer should be a percentage. So please take note of this. Now, the figures that we are going to be using in order for us to calculate these profitability ratios, we are going to get them from our income statement. Now, what do they really indicate, these profitability ratios? They are going to indicate how, if the business is in a position to generate profits. So we are generating gross profit and then ultimately net profit. How good is our business in generating profits from this given sales? And then it is also going to look into how we are effectively using the business assets in generating income. So please take note. We are also looking into if the business is in a position to efficiently and effectively deal with their expenses, keeping them low so that at least we can be in a position to generate as much profit from the given sales. That's profitability ratios. Please remember, the minute they give you a profitability ratio to say percentage net profit on sales, it's net profit over sales. Don't forget that formula because you really need it. Now, the next class that we are going to look into is the liquidity ratios. Now, you are going to see that on this slide, I'm giving you just 2. The first basic liquidity indicators are the current ratio and the asset test ratio. Now, current ratio. From our balance sheet, you still remember we looked into current assets and current liabilities. Those are the two current items that we dealt with. And then we bring them together in order for us to calculate our current ratio. So it's comparing current assets and current liabilities. Now check, guys. Which one is supposed to be more? Current assets or current liabilities? I know you said current assets. That's good. Now, acid test ratio is now just indicating another item in there, because on our current assets, we are subtracting inventories. Because of the three current assets that we have, inventories is the one that is more difficult to convert into cash. So we are saying, let's assume we take away stock. Can we still be in a position to pay off our current liabilities? Acid test ratio. We are putting our current ratio into acid and seeing if it passes the acid test. Now, please take note for these two, the current and the acid test ratio, they are there to look into the business ability to pay off its short-term obligations. So what are we going to use to pay off our short-term obligations? We are going to definitely use our current assets. So that's the basis on which we are going to be calculating our current and acid test ratio. And then where do we get information for us to be in a position to complete these two ratios? We definitely get this from the balance sheet, because that's where we are going to have our current assets from, and that's where we can also get our current liabilities from. Now, the next set of liquidity ratios that we have here is the stock turnover rate and the stock holding period. Now, let's look into the stock turnover rate first. The stock turnover rate indicates the number of times at which we are turning over our stock. So it therefore means the faster we turn over our stock, the better. The higher the stock turnover rate is, the better. Now, our stock turnover rates indicates if we are not getting to a point of stockpiling. We only stockpile if we are having a very low stock turnover rate, because it means we are not turning our stock faster. And then we move on to the stock holding period. This is looking at the period that we are taking in order for us to be in a position to finish the stock that we are having. So it means now, if we are having stock that is worth 200,000, how long are we going to finish that stock? Stock holding period. Now, the stock holding period assists the business to plan on stock replacements. When do we replace stock? Please, before we forget, let's look into the formula. I like this one because for these two, the first one just says cost of sales divided by average stock. But remember, average stock, not divided by stock, but average stock. So it therefore means when you get to the denominator, how do we get our average stock? We take the opening stock, we add to the closing stock, and then we divide these two by 2 to find our average. But when it gets to the stock holding period, please check the name. The minute we say period, then it means we are supposed to have either the number of days or the number of weeks or maybe the number of months. And we are talking of in a year. So it therefore means we are going to multiply by something to indicate whether we are going to have days, months, or weeks. So in this case, the stock holding period is going to use the same formula as the rate of stock turnover, but upside down. Average stock is divided by cost of sales. And then please remember, if they want it in days, we multiply by 365. But if the answer is supposed to be in months, we multiply by 12. Check. The answer for rate of stock turnover, it should be in times. So if you get 10, it means 10 times. It's in times. But when it comes to the stock holding period, it can be in days or in months. So you can say 60 days, or you can have 2 months. So it has to be, we need to indicate the units to which we are going to be calculating these indicators. Now, let's move on to the next set. So you can see we are bringing them in sets of 2 here. We had the first 2, current ratio and acid test ratio. The second 2, stock turnover rate and the stock holding period. Now we have got this set. Average debtors collection period as well as the average creditors payment period. Now, debtors collection period. How long are we taking to collect from debtors? A business that takes a few days to collect from debtors is managing debtors effectively and better than a business that takes very long to collect from debtors. At the same time, we need also to check how long are we taking to pay our creditors. Now remember, we need to be in a position to go to our creditors and negotiate for a longer payment period. But remember, we are the ones paying here. So if they give us 30 days, we must pay in 30 days. If they give us 60 days, we must pay in 60 days. If they give us 90 days, let's take advantage of the days that they are giving us. But at the end, we must pay within the allocated period. Check the formulas, please. That is very important, because when you have those formulas, they must always be in you. You must always remember them, because they are the ones that you are going to be using when it comes to calculating. Answers to these 2, it's going to be in days. Now, please check what are we saying about the average debtors collection period. Now, a business can experience cash flow problems if debtors exceed the credit term. And usually our credit term is 30 days. We expect all our debtors to have paid us within 30 days period. And then when it comes to the average creditors payment period, we are saying it indicates how long we have negotiated to be paying our creditors. And please take note, when it comes to these 2, we must always be in a position to try, if possible, to take a little bit longer, to negotiate for a little bit longer period of paying our creditors, so that we can use the money that we are collecting from debtors to pay off our creditors. Let's move on to the next class. We are now going to look into these 2. Solvency. We are only having 1 solvency ratios. Now, solvency, we are looking into whether our business is solvent. A solvent business is a business which is having more assets than its liabilities. The rationale is a business can only pay its liabilities using its assets. So if we are having a situation in which a business is having more liabilities than assets, we are very much in trouble. We are having an insolvent business. So what does it looks into? Total assets as to total liabilities. Now, please take note. Your total liabilities, which is on the right hand side, is always, when it comes to the answer in the ratio, it should be as to 1. So it means now you divide the figure of liabilities into our total assets, so that we can be in a position to come up with the ratio. So the ratio can be 16 as to 1, 5 as to 1, 2 as to 1, on this case, always your liabilities side is always S2, 1. Always indicate your answer as a ratio. Now, the next class is on financial risk or gearing. Now, I always say, when they say gearing, think of a loan. When they say gearing, think of a loan. We are saying, how much is our business relying on borrowed capital? Now, a business that is relying too much on borrowed capital is far much in risk than a business that is relying more on its own capital, which is our ordinary share capital. So we are comparing our non-current liabilities as to our shareholders' equity. But please remember, in our balance sheet, there is only one item under our non-current liabilities, which is our loan. So that's the reason why when you are looking at non-current liabilities, you're just looking into the loan figure and then you compare it to shareholders' equity. Class of 2022, this ratio in the exam, examiners, they love it. So please always expect it. Check the formula. Non-current liabilities as to shareholders' equity. Remember, the shareholders' equity side is always going to be 1, and then it means it should be 0 point something on the left-hand side. Now, the solvency, the ability of the company to pay off all its debts. And then debt equity, it indicates how the company is financed, if they will be able to meet long-term obligations, and it indicates also the level of financial risk that the business is facing. Now, we move on to the next class of ratios, the return ratios. Please look into these two. A little bit look like the same, but very different. The return on shareholders' equity. The return on shareholders' equity. Please remember, whenever you see the word return, we are looking into net profit, right? Because whenever you invest in a company, then the profits that the company is going to be make, that the returns to the shareholders. So in other words, returns simply goes to profit. That's the reason why when you get to the formula, you can easily remember the formula now. Return, this is net profit after tax. On shareholders' equity, it means we need to divide by average shareholders' equity. Please remember, average. I'm bringing it again. Average. It means we are going to need an average shareholders' equity, not shareholders' equity at the start or shareholders' equity at the end. So it means you take the start and the end, you add them together, and then remember to divide it by 2 to find that average. We are going to look into something like this. So please remember the formula, and the answer is, whatever you have, you are going to multiply by 100 over 1, because the answer should be a percentage. Now, the Rocher reports on the profitability and returns. In other words, we are saying, if there were other alternative investment out there, were you still going to be in this business? So if your business is giving you a returns of 10%, and out there is another investment opportunity that gives you 15%, are you still going to be stuck in your business? Definitely no. And then we move on to the return on capital employed. Now, when we talk of capital employed, we are saying capital that the shareholders invested into the business, as well as borrowed capital. Remember, a loan is borrowed capital. That's the reason why when we look into our balance sheet that we looked into last time, when we get to financing activities, we are looking into shares and we are also looking into the loan. Financing activities. So in other words, when you talk of capital employed, we are saying shareholders' equity plus the loan. So you are going to see that when it comes to the formula now, the return is not simply the net profit that the business have made, but it's going to be net profit before tax plus interest on loan. And then when it comes to the average capital employed, it is going to look into the shareholders' equity at the start of the period plus the loan at the start of the period. And then we go to the end, we do the same. Shareholders' equity at the end plus loan at the end. We bring them together, we find an average by dividing by 2. You are going to see that when you go through an activity where you are expected to calculate this, when it comes to the denominator part, usually you are going to have 4 figures to represent the shareholders' equity at start and at the end, plus the loan at start and at the end. Then when added together, you are going to divide that by 2 to find an average. Now, the return on capital employed is compared against the interest rate. Remember, this one also helps us to look into how risky our business is. So if the return on capital employed is 10%, and then the interest on loan somehow is 15%, what does that mean? It means the cost of borrowing is far higher than the returns that we are getting from employing this capital. The cost of borrowing becomes higher than the returns that we are getting from using this capital that we have borrowed. So is it a good decision to keep on borrowing? I don't think it is. So we are going to look into also when we get to where we are supposed to comment and interpret these financial indicators. Now, we are going to also look into the next one, which is still on return ratios. Now, there is the earnings per share and the dividends per share. The earnings per share, it's looking into how much of that profit is every share contributing to the profit. How many cents is every share contributing? So if we are to have 1 share, how much is it contributing towards profit? So the formula is going to be return, remember, return per share. There is my colleague who said per share. You know, he wanted to go overseas with this. Earnings per share, it's net profit after tax divided by the number of issued shares. So whenever they say per share, you divide by the number of issued shares. And then we multiply by 100, not because we want this answer to be a percentage, but we want to know how many cents are being contributed by every share that is held towards the returns, towards net profit. So the answer that we are going to get is going to be in cents. So it's going to be 50 cents per share, it's going to be 100 cents, 300 cents, or 900 cents, depending on how much every share is contributing towards profit. Now, we also look into how much is every share contributing towards dividends. Now, the rationale here is, guys, if our business is earning 100 cents per share, we are not going to give all the 100 cents to the shareholders, but we are going to take part of that and give to the shareholders, which is not always the case though, Sometimes you can find a business where it have made 100 cents and they decide to give 120 as dividends to their shareholders. In that case, it means they are giving back all the profits to the shareholders as dividends, plus taking from previous retained earnings and giving to shareholders. It's simply like a boyfriend who goes earn a salary of 10,000 at work and give 12,000 to the girlfriend. Earnings per share. And you can see there is a sort of a relationship that is already coming up here. Your earnings brings about the dividends. Check the formulas and always remember the formulas, because that's what we are going to work with. Now, earnings refer to the net profit after tax, as already indicating. Dividend per share is determined, it determines the level of profit that have been generated. Now, let's look also into the next class of indicators. These have got something to do with the returns and the market prospects. So we are looking at the net asset value per share. So here we are saying, how much is every share contributing towards the assets that the business has? Now, this is a little bit interesting because most of us, we forget that our shareholders' equity is our net assets. Shareholders' equity is net assets. How do we find net assets? Total assets minus total liabilities. Total assets minus total liabilities. That's net assets, right? How do we find shareholders' equity? Total assets minus total liabilities. So that's the reason why when you get into the formula, it says shareholders' equity divided by the number of issued shares per share. Per share divide by the number of issued shares. Remember these formulas, guys. There's nothing more that I need from you than remembering the formula. Because as soon as the formula is in you, then applying it is one of the easiest things that you can ever do. And then we also have the dividend payout rate. The dividend payout rate. We are saying the rate at which we are giving away dividends. And check here, where are we getting the dividends from? From the earnings. So that relationship between earnings and dividends comes to the front. So how do we get our dividend payout rate? It is simply dividends per share divided by earnings per share. Please check the second formula that I've given you there. Dividends per share divided by earnings per share. But this we can also get the same by using the dividends, not per share, but the total dividends for the year, and we divide it by the net profit after tax. Remember, in both cases, we multiply by 100 because we want our answer to be given as a percentage. We want our answer to be given as a percentage. The net asset value is always compared to the market price. So we are saying if the value that every asset have contributed towards our assets is 10 Rand, we expect our shares to be sold at 10 Rand on the stock exchange. But this is not usually the same, and it's not usually the case. Remember, when it comes to the stock exchange, it have got something to do with the demand and supply of those shares. So it might happen that though every share is valued at 10 Rand, it is highly demanded such that people are prepared to pay 15 Rand for that share. So you are going to see there is always a comparison that comes into effect when we look into the net asset value versus the market price of a share on the JSE. And then, if the net asset value is lower than the market price, then it means investors have confidence in the business, because we are saying the market price is what investors are prepared to pay. So if they are prepared to pay more than the actual value of the shares, we are in gold here. It means our shares are on high demand. Now, please always be in a position to look that the activities that we are given always brings about that notion of comparing between the net asset value as well as the market value. Now, please take note. Grade 12 learners, we are fortunate. Starting just 2 years ago, we are getting the formula sheet in every exam that we get into. And this is exactly what the formula sheet looks like. This is half of it. Check something that I'm seeing here. The first one that you are given there is gross profit over sales multiplied by 100 over 1. That's it. If you don't know what that ratio is, then it means that formula is useless to you. I know that formula is used to calculate percentage gross profit on sales. Can you say the same to you? Now, let's just look into maybe one of these. I'm taking the last one down there. It says cost of sales divided by average trading stock. Do you remember what it is? The 1 for. This is the rate of stock turnover. So if for any reason you don't know that this is the rate of stock turnover, it simply means we are not going to win here. So you are always given the formula sheet and check this is the next page of the same formula sheet. We are given this. It is our role to be in a position to just say this one is used for which one. So we need to know these ratios by heart. The formulas are given, but sometimes if we are not sure which one is used to calculate debt equity ratio, then even when we are looking at the formula sheet, that answer is not going to be given to us. So please always remember this. The formula sheet is given, it's at your disposal. Even with your teachers, when you start this chapter, they are going to give you the formula sheet. Please always remember to work with your formula sheet to say the teacher says calculate the debt equity ratio, which one is the debt equity ratios, so that we can be in a position to get used to those. When they say calculate your return on capital employed, which one is the return on capital employed, so that you won't get lost in the exam when it's towards the end. Now, please take note, there are ratios that are related because they help you to be in a position to make a decision around a number of issues. Now, that's exactly what we are going to be looking into now. Now, which ratio is related to our net asset value? Which ratio or financial indicator is related to our net asset value? Please check here. It is related to the market value of shares. Now, this is usually on the JSE. That's what they always indicate. The market value of a share on the JSE. Now, the higher the market price indicates that the shareholders have confidence in the company's shares. So let's assume we are faced with this situation in which we are having the market price being 15 rand and the net asset value being 12 rand. What does this mean? It means the true value of shares is 12 rand, but our shareholders are demanding more of our shares to the extent that they are prepared to pay 15 rand per share. What does that mean? It means shareholders have got confidence in the company's shares. which means when we swap figures now and we are having a situation in which we are having our shareholders not being able to pay as much as the net asset value, it means they have lost confidence in the company. And because of that, they are not even paying similar to the value of the shares. Very important. I think we are going to have an activity which is going to help us to look into this and see how definitely they are going to relate. Now, the next one is the ROCHE, the return on shareholders' equity. Now, the return on shareholders' equity is usually compared to the rate of investment. We mean other investments. So it means if our company is getting or is giving us a rate of return of 12%, but there are other investments out there which can give us 15%. Should we continue investing into this company? I don't think there's need for us to keep on troubling ourselves, because we can just take our money, invest it into something that gives us higher returns than we are getting from the current investment in this company. So the ROCHE determines if the business should invest funds somewhere. So if there are alternative investments with a higher return, let's go and take our funds there than to waste our time and effort in something that is not giving us much returns. And then when it comes to the next one, the return on capital employed. The return on capital employed. This goes versus the interest rate. The interest rate. Because we are saying how much is the cost of borrowing. So if we can borrow at a lower interest rate and get higher returns, we are smiling, because we are still going to be able to pay off what we have borrowed and still going to remain with something. So if you check here, when the ROTE is above the interest rate, it is positively geared or is favorable. It therefore means we can still go on and borrow, but use this money to get higher returns and then smile all the way to the bank. But the minute we are going to have the ROTE being less than the interest rate, then it means we are in trouble. It means we are working to pay off interest. The interest is now eating up our profits. It means now the cost of borrowing is now suffocating our business and we are not doing much to ourselves. Please take note. So whenever we say comment on ROCHE, at the back of your mind, think of alternative investments. When you say comment on the return on capital employed, somewhere the interest rate should be lingering in your mind. That's how they are related. Now, we also have got to look into debt equity ratio. Now, whenever we talk of the debt equity ratios, we are looking into whether we are depending too much on loans or we are depending more on our own share capital. So the more it becomes 0.7, 0.8, it means the business is relying more on borrowed capital, which is not good for business. So you are going to be looking into low gearing and high gearing. Low gearing being when we are not depending much on borrowed capital, and high gearing is when we are depending more on borrowed capital. But please take note of something here. A business can be low geared and we smile and say we are not relying too much on borrowed capital. But at the same time, we can also have a higher interest rate, which means the cost of borrowing is suffocating us. When the cost of borrowing is now too high, we cannot keep on relying on any loan. So sometimes we are discouraged from borrowing because of the interest rate. So the debt equity measures the degree of financial risk. Lower ratio indicates creditworthiness, low gearing. But at the same time, use of borrowed funds is favorable when the interest rates are lower. If the interest rate increases, it's not going to be at our advantage to keep on borrowing. Now, let's look into earnings per share. This one we already said it. It's related to dividends per share. We expect to give our shareholders dividends out of what we have earned. We are expected to give our shareholders dividends out of what we have earned. So we are saying earnings are distributed and some must be retained for future and further expansion of the business. So it is always a good thing for having a business which have got dividends per share being lower than earnings per share. And remember, we can use this to calculate the dividend payout rate. And our payout rate should always give us sufficient returns, because the returns are there to be used by the business for future expansion. So we wouldn't want to see our business stagnant and not going anywhere. We would want to see our business growing, and it can only grow if it retains some of the profits that you have made and use it for expansion, not to give all of it to the shareholders. And then lastly, we are having our debtors collection period. This is going to be versus our creditors payment period. Please take note. We must always insist on our debtors paying us within 30 days. And at the same time, we should be clever enough to go to our creditors and negotiate for a longer payment period. Why is that? We can go and buy stock on credit from our creditors, sell it to our debtors, insist that our debtors pay us back on time, and then we are going to use the same money to pay our creditors. But this should be within the agreed time period. So we take very few days to collect money from our debtors and then pay our creditors within the agreed period of time. Now, whenever you comment, please don't always look into only that financial indicator that you are given. Sometimes you also need to look into what is related to this financial indicator so that we can be in a position to give a comprehensive comment that makes a good sense. Please take note, at this point now, we are going to move on to the second part of the segment, where we are going to look into an exam question in which we are going to apply the knowledge that we have gained from this segment. So please take note, we are going to look into the calculation of financial indicators as well as the commenting part. And we are going to be using a paper in last year's national paper, which was our prelim paper. This paper was a trial exam, but it was national. And we are going to use questions that are extracted from this question for our next segment. Please take note now. Let's go through our question. The first segment, we are just going to look into the calculations where we are calculating financial indicators as required. Now, please take note. The question, it's saying here from question 2, which is 2.2, the information relates to the financial year ended 29 February 2020. You are required to calculate the following financial indicators on 29 February 2020. And then these are the indicators that you are required to calculate: the debt equity ratio, earnings per share, dividend payout rate, percentage return on shareholders' equity. These are common ratios when it comes to examiners. They need them. They look for them. They are always asking you to calculate these. So please always remember you have got. So let's check the first one, debt equity ratio. Now, when it comes to the debt equity ratio, remember the information is extracted from our balance sheet. What do we need? Debt, loan, debt, loan, and then shareholders' equity. So we are looking into the non-current liabilities versus shareholders' equity. So our information is like this. We are given two base years here. We have got 2019 and 2020. Please check the arrangement always and check the dates always. Which one is the year to start and which one is the one that is given. So in this case, we are going to calculate the debt equity ratio for the year 2020. So it means this information, we are not going to require this, but we are going to require the information under the year 2020. Now, what do we need? Debt, loan, debt, loan. So the first thing that we need is the loan. This amount, 900,000, which is the loan from BB Bank. This represents our debt. This represents our non-current liabilities. And what else do we need? Shareholders' equity. This is the figure that we are looking for. 8,980,300 rands. Now, please take note. It might happen in your exam that they are not giving you this figure, but they are also giving you this. Remember, simple balance sheet logic. We add ordinary share capital plus retained income to get shareholders' equity. Let that not fool you. So please remember the formula. Non-current liabilities as to shareholders' equity. So remember, you are not going to be awarded any marks for repeating this formula because it is a formula that is given on your formula sheet, and we expect you to be singing this formula by the time we get to the prelims. I will not say anything about the time that you are going to be writing your final exams. It is going to be your second nature. So what we are interested in are the figures thereof. So what is it going to look like? It's simply 900,000 representing your non-current liabilities and your 8,980,300 representing your equity. Now, remember what I said. Your right-hand side on the shareholders' equity, it's always 1. So it means you already know as to 1. So how do you find your left-hand side? You are going to divide now that figure into the loan. So it's 900,000 divided by on your calculator, and it gives you 0.1. So your answer is going to be 0.1 as to 1. Simple, straightforward. I think these are 3 marks for doing absolutely very little. Please don't lose such marks. We are going to look into the next financial indicator as required by our question. It says we are supposed to calculate earnings per share. Now, when it comes to this one, we need more than just one financial statement from which we get our information. We are going to need an income statement to find our earnings, which are in this case net profit after tax. And then we are going to need our balance sheet so that we can be in a position to identify the number of issued shares, or maybe some additional information for us to be able to do that. Let's see what this question brought us as information. It gives us our net profit after tax, and we are happy. They also gave us share capital, the number of shares, but it's not just a figure. They are giving us what happened. They are saying on 1 March 2019, this signifies the start of the year. The ordinary share capital comprised of 800,000 ordinary shares. Very important. So we started our financial year with 800,000 shares already issued. And then they said a further 200,000 shares were issued on this date. So it means when the year started, before we went anywhere else, we issued an additional 200,000 shares. What happens whenever we issue shares? The number of issued shares increases. So 200,000 plus the original 800,000, I can see 1,000,000 shares already issued. And then they said, on 29 February 2020, this is the final day of the year. This is the end of the year. The company repurchased 90,000 shares at 81,000 above the average value of shares. Now, the average share price is given as 9.10 per share. Then they said these shareholders, they qualified for final dividends. So the buyback check here is taking place on the last day of the year. It would be unfair to say, because we are buying back your shares, we are not going to give you your dividends, though you have been shareholders throughout the year. So in other words, how many shares are we going to use as the number of issued shares? Are we going to use 800,000 plus 200,000, or we are also going to subtract the 90,000? Now let's check. I think we cannot subtract the 90,000 when it comes to the number of issued shares. Why? Because 1,000,000 shares got interim dividends and 1,000,000 shares got the final dividend. So when we are looking into the dividends per share, we are looking into the dividends on 1,000,000 shares. So this is the formula. Net income after tax divided by the number of issued shares, and we multiply by 100 because we want to make sure that our answer is given in cents. That's not to make it a percentage. So into this formula, it's going to be 968,800, which is the net profit after tax, divided by 1,000,000 shares that have been issued to date, and we are going to get 96.9 cents. Please take note. 4 marks for doing nearly nothing, but I like it. If you know your story, then you are having a number of marks already. But please take note something for me. When we are looking into the next one now, when we are looking at the payout rate, we need dividends per share, and we have been calculating dividends per share. So please always remember, when we are given something that we have got to calculate and they are asking us something in the next one, we are using that figure. Now, even if that figure is not correct, we are going to accept it for the sake of our continued calculations. Because remember, we are not marking you on a figure, but we are marking, or we are assessing you on whether you can be able to apply correctly. So let's look into the next one where we are calculating the dividend payout rate. What are we given? We are given the earnings per share. Here, there's nothing, but we know we have done a calculation and we got 96.4. We have done a calculation. We've got an answer. So this answer, we are going to be using it. But now, we are not given dividends per share per se. But please look at this. This is interim dividends per share, and this is final dividends per share. Dividends for the year is made up of interim plus final. So we can safely add this 12 plus this 28 and simply get a 40. It means our dividends per share is 40 cents. And our earnings per share is 96 point, I think it's 7 or 4, but I think it's 7. Now let's check into the information that is given. There is the formula. Dividends per share divided by earnings per share. Let's put in figures there. 40 cents divided by 96.9 cents. Check. We just divide and multiply by 100 and we get our answer. And in this case, it is 41.3%. It simply means we are giving out 41.3% of the earnings away as dividends. The rest we are retaining it. So what percentage are we retaining? What percentage is our retained income? It is going to be our 100 minus the 41.3%, which amounts to something like 58.7%. We are retaining that percentage. Why? For future expansion of the business. Please take note. We are interested more in the calculation. Take the information into the formula that is given to you, as long as you know which formula to take from the formula sheet. Let's check on the last one. They want us to calculate the percentage return on capital employed. Percentage return on capital employed. Now, please take note, when it comes to the percentage return on capital employed, it is net profit. We divide this by capital employed. In this case, I think there is a mistake here because it says capital employed. It's supposed to be shareholders' equity according to the question that we had. Shareholders' equity. Percentage return on shareholders' equity, not on capital employed, because it will mean a different calculation altogether. Now, what are we doing here? We are looking into our net income after tax, which is given, and then we need an average shareholders' equity. So it means we must take these two figures, add them together, and divide by 2 to find the average. So having the formula the way it is given, now let's see how it is going to be done. It is going to be simply now shareholders' equity. Now it is going to be 968,000 divided by the closing shareholders' equity plus the opening shareholders' equity. And it's half of that, so it means that should be divided by 2, and we multiply by 100, and the answer should be 11.8%. Please don't just take my word for it. Do these calculations also on your own and see how it works out. Also do these calculations and see how it works out. We want the correct thing to be done. Some of us, we don't even know how to use our calculators because in class we are always expecting other people to do it for us. Please, just take your calculator every day to an accounting class and use it. Not just to sit on it, but to use it. Learn to use your calculator. The more you use it, the faster you are, and the more you know your functions, and you are not going to waste unnecessary time in the exam. Now, the next part that we are going to look into now is on interpretation of financial indicators. Now, for this type of a question, you are going to be given financial indicators and some other important financial information. And usually what happens, you are going to be given for 2 different years so that comparisons can be made. Or you are going to be given for for 2 different businesses so that comparisons can be made. So if you are given different businesses, usually you are given businesses that are in the same industry so that we expect the same to be plus or minus for those types of businesses. So we are going to have a question in which we are given 2 base years. So it means we are given 2 years that we are going to use to compare. The key is we are comparing, and then we are giving a comment based on what we have seen in our comparison. You are provided with information of Solar Style Limited for the financial year ended 29 February 2020. The business provides solar panels to shareholders to supplement their electricity supply. What are you required to do? Please take note, before even we get to what is it that we have to do. Provide figures, provide financial indicators or calculations in each case to support your comments or explanations. So it therefore means when it gets to this topic on financial indicators, your explanation alone is not enough if not supported by figures. Your explanation alone is not enough if not supported by figures. So check figures, check indicators, check ratios, check some calculations that you are doing in order for you to be able to use it to support whatever you are saying. It is very important. Now, you are required to look into the first one. 3.1, it's saying solvency and liquidity. So it means it's guiding us on what we are going to look into. Now, if I am you and I'm in the exam and they say solvency, I already know which one am I looking into. Remember, it's our total assets versus our total liabilities, solvency. And at the back of my mind, I already remember the 6 liquidity ratios because there are only 6. Guys, you can't say you can't remember the 6. And then not all 6 are going to be provided to you. So it means out of whatever information we have, you are supposed to take out the 2 or the 3 that they are looking for in order for you to comment. And please remember, when you comment, you cannot comment on an indicator that is not provided, even if it is an indicator for the class that you are supposed to be commenting on. 3.1.1 says, comment on the solvency of the company. Quote one financial indicator with figures. There you are. You want to comment on solvency. And now, what is it that you are looking at? This is the only indicator that have got something to do with solvency. So what are you really doing there? You are looking into solvency in 2019 versus solvency in 2020. So you are going to just tell the examiner that the total assets to liability ratio declined, decreased, changed from 5 to 1 to 2:1. That should be very clear. So that's what you are just doing. And then let's look into 3.1.2. It says, explain why the directors are satisfied with the change in the liquidity of the company. Quote 2 financial indicators with figures. So it means 1, the first part of the question, though it's not saying it, they are asking you to identify 2 liquidity indicators. So please take note. there is the acid test ratio as a liquidity indicator, and the rate of stock turnover as a liquidity indicator. Let's check. What is it that we can say about the acid test ratio? When the acid test ratio is like this, we are having, this is indicating current assets less stock. So it means we are having too much cash and debtors that we are holding on to pay off our current liabilities. But 2.6 is too much. So it means these resources are lying idle without being used. Remember, we are talking of cash. Cash mustn't sleep. Cash must always go out there to look for more cash in business. So it means when it is moving to 0.8 as to 1, it's far better. Though we are saying after subtracting stock, we are having less than per rent of liabilities that we can use to pay. But this is nearly 1 as to 1, which gives us, so it means our resources are no longer idling as compared to the base year. So you are going to indicate that the acid test ratio first, we know, and then we are going to say it have changed from 2.6 as to 1 to 0.8 as to 1. We need those figures. Those are going to tell us whether you really understand the information that you are dealing with. And then you are going to tell us the good part. Why are the directors or why are the shareholders satisfied with this? Now let's look the rate of stock turnover. 3 times. It have doubled. Everyone should smile about it. It means we are now turning over our stock faster. It means we are selling our stock faster. It means we are now converting our stock to cash faster, which is a good thing. Now, please look into the expected responses when it comes to this, starting with the one on solvency. Now, the degree of solvency have declined from 5 to 1 to 2 to 1. It have declined by about 3 as to 1. Now, although the solvency have declined, the trend is, the business is still solvent. So as long as the business is still solvent, we are happy. So there is a decline in solvency. It therefore means now when we compare to our assets and liabilities, we were having 5 rands per every 1 rand that we have borrowed in the first year, but in the second year we are having 2 rands for every 1 rand that we have borrowed. But we are still having a positive ratio here, which is good. As long as we have got more assets to pay off our current liabilities, we must smile. To pay off our total liabilities. Now, let's move on to this. When we are looking into comment on the liquidity ratios, what can we say about the acid test ratio? It is now more efficient at 0.8 as to 1, whereas it was too high at 2.6 as to 1 in 2019. So we can say there is more productive use of liquid assets or more productive use of our working capital. It is better when our business is at this point. And then what can we say about the rate of stock turnover? It has improved from 3 times to 6 times, indicating that stock is being sold more quickly. We are converting our stock to cash at a faster rate. Very good for a business. So please always be in a position to see what are these ratios saying to you, so that you can be in a position to make the comparison and the comments. And I will never be able to overemphasize the fact that whenever you are commenting, then there is need for you to comment using figures, indicators, ratios, calculations. We need to see figures there. Let's move on to 3.2. Now they're saying here, this 3.2 is based on earnings, return, and share price on the JSE. The first part of it says, comment on the percentage returns and earnings per share of the company. Quote two financial indicators with figures. We are commenting on two things, the percentage return and the earnings per share. This one is straightforward, earnings per share. Now, when they're saying percentage return, what are they referring to? Please take note. They are referring to our percentage return on shareholders' equity. Percentage return on shareholders' equity. Now, this is the information that is provided to us. Check. Earnings per share, 96 cents in 2019 and 72 cents in 2020. This signifies a decline in earnings per share. Our shares are earning less in 2020 than they were earning in 2019. Let's look into the ROCE. It was 8.7% in 2019 and it have declined to 5.3% in 2020. So it also means here our return on shareholders' equity have gone down in those years. But now remember, we said there are always related ratios. So whenever they say earnings per share, there is a relationship between earnings per share and the net asset value. Now, so in order for us to answer the question, now what else do we need? We need some other additional information such as the market price per share, because this one have got something to do and it is related to the indicators that we are going to be explaining on. So what is a model answer that can be there? Now, to answer on the return, percentage return, what happened to the ROCE? It have declined from 8.7% to 5.3%, as we have already looked into. And you can say, instead of saying declined from 2, you can just find the difference between the two and you say it have declined by 3.4%, which is about 39% compared to the alternative investment. So you can check now, whenever we comment on ROCE, we compare to alternative investments. We compare to alternative investments. Now, let's check now when we go to earnings per share. Now, earnings per share have declined from 96 cents to 72 cents. Or we can say it have declined by 24 cents. So it is now either just giving us the information as raw as it is, from so much to some as we get clearer and cleverer, we can also now look into the difference, that so we can say it have declined by so much percent, all that. And remember, when it comes to this now, what does that mean? It means there is a drop or there is a decline in the productivity or the profitability of this business of ours. So it therefore means we are getting poorer because we are getting fewer returns compared to what we used to in other periods. Now, because of that, we can now be in a position to check our earning yields. We can do that. There's nothing stopping us from doing that. To say now, let's compare the earnings to the net asset value. Or we can compare the earnings to the market price on the JSE. That's the reason why I was saying to you, always remember the ones they are related to, because it is that relationship that helps you to be in a position to identify which one to work with and how to apply it. Now we are moving on to the next one, 3.2. Now 3.2.2, it says earnings, returns, and the share price on the JSE. Comment on the share price on the JSE and how the percentage return and the earnings per share have affected the share price. Please check here. The best we are going to deal with is the share price on the JSE. And we are saying, how is it affected by this? And how is it affected by this? So we are going to be in a position to say, what happened to my percentage return? And how is it going to affect our share price? Please look into that. We are saying, what happened to my percentage return? And how is that going to affect the share price on the JSE? And we are going to say, what happened to our earnings per share and how is it affecting the share price on the JSE? So we are saying here, whatever happened to our percentage return have got a significance on what is taking place on the share price on the JSE, as well as what happens to our earnings per share have got a ripple effect on what is going to take place on our share price on the JSE. That's the reason why you can see we are bringing the ROCE for the percentage return. We are bringing the earnings per share, and then we are bringing the share price on the JSE. So let's check what happened to the share price on the JSE. It have gone down, it have declined, it have changed from 9 Rand 20 cents to 8 Rand 40. That's a decline. It means the demand for our shares is declining. It means our investors are losing confidence in our business or in the company, to the extent that they are demanding less of our shares. And as they demand less of our shares, then the share price on the JSE is going down. So let's see how best we can be able to comment on this. Now check here. They are saying the decline in earnings, which is declining in earnings per share, has led to the decline in the share price on the JSE. But I told you, it's nothing without figures. So tell us, it have declined from 9 Rand 20 to 8 Rand 40, 920 cents to 840 cents. Now, we can even check how much is the percentage drop or the number of cents drop. And then it signifies loss of investor confidence. Now, we can also look into a comparison between the market price and the net asset value. Now, we are going to say the market price of 8 Rand 40 is lower than the net asset value of 877 cents. So it is 8 cents lower. Now, what does that mean? It is just signifying a decline in the demand of the shares. So we are saying you must be in a position to look into how the price at the JSE, which indicate investor confidence, is affected by other things that are taking place in the business. Very important, so that you can be in a position to comment. Now, I am going to take us to the last one that we are going to comment on and looking into today. That is gearing. Remember what we said about gearing. Gearing have got something to do with looking into how are we relying on borrowed capital. How much is the business relying on borrowed capital? Gearing. Now, this question 3.3 is saying, explain how the loan affected the risk and gearing, and whether or not it was a good idea to increase the loan. Now, we are looking at two things here: risk, gearing. What is it that we are going to use to look into gearing? This is the debt equity ratio. But for risk, what are we going to be using to check on risk? This is our return on total capital employed. Now, remember, the minute they say return on total capital employed, then our interest rate is very important. Which interest? Interest on loan. Because we're saying this is what we use to be in a position to compare with. And then remember also, it have got the same effect on this, the interest rate. Very important. So check what's happening to our gearing. Debt equity declined from increased 0.3:1 to 0.4:1. Let's check what happened to our return on total capital employed. Went down from 11.6% to 6.2%. Now, we can also see what happened to our net asset value per share, which is not in question for now. But let's look into the additional information that is given. What happened to our interest rate? The interest rate declined from 12% to 10.5%. Please take note that. Now, when we are commenting now, there is first part of the comment. Let's comment on debt equity alone. So changed from here to here. That's it. But is this a good thing? Our business is still low geared. When it's low geared, it means we can still borrow, right? Because we are still credit worth. But let's check here. Are we benefiting from borrowing? Because our percentage return decreased from 11.6 to 6.2. Now, let's now check here. 6.2, it means that's the return that we are expecting. But what is the cost of capital? The cost of borrowing. The cost of being financed from loan is 10.5. Is this a good time to borrow? Is it a good thing to borrow? No. Because at the end, they said we are supposed to give a decision whether it's a good decision to increase a loan. Was it a good decision to borrow? Now, from this information, it's straightforward that it is not good to borrow. So this is what we are expected to indicate as our answers. The debt equity ratio increased from 0.3 to 0.4, all by 0.1:1%. 0.1:1 as a ratio. And then the ratio decreased from here to here, from 11.6 to 6.2, which is by 5.4%. Now, what does this say to us? Although the debt equity ratio suggests low financial risk, the ratio is very low. The debt equity ratio, we are still low geared, but the ratio is too much lower. And because of that, can we go on and increase the loan? Is it a good idea to increase the loan? Definitely no. The business experienced negative gearing, and the interest rate, check what it is, at 12%, and has not taken steps to improve the situation. So it's, if you can check, our situation is not improving. So if our situation is not improving, then why should we keep on borrowing? So it means there is more financial risk because profits are going down. So our business is not getting any better. The decision is not to increase the loan. The decision, it is not good to increase the loan. It is not a good idea to increase this loan. That marks the end of our lesson today. Thank you for watching this lesson. Thank you very much from me and the team behind the scenes.